Good morning. How is everybody on this Monday morning?
Morning.
Morning.
How we doing?
They're doing
Oh,
good. Market's not so much.
Well, if you shorten it, you're okay.
that's true. That's a good. Always the sunshine somewhere.
Listen,
Yeah.
I'm dabbling because the the trend is your friend right now with this. I'm just dabbling, kind of neat.
Yeah.
Yeah.
So trying to hedge
I
a
Yeah.
little,
bought
I guess. Hedge.
I bought some puts on Friday on it. SPY. Yeah, April 17th. Puts a little out of the money just because
Well,
it just
since
looks
we
like
got 30
fun.
minutes, let's get rolling. It's 7:31. So I like to keep these morning meetings moving. So good morning. Today's March 10th, 2025. Welcome to the Morning Edge, provided by the Platinum Channel. Just a reminder, this information is for educational purposes only, is not financial advice or recommendation to buy or sell stock. Stock market futures this morning are down way over 1% to 1.5%, depending on which index you're looking at. Mega cap stocks like Nvidia lost 2% pre-market. Meta and Amazon down 1.3% each. Tesla fell 2.6% after UBS lowered its forecast for the automaker's first quarter deliveries and cut price target on the stock. Futures tracking the more domestically focused, smaller cap Russell 2000 declined almost 1%, while markets flocked to safe haven treasury bonds today. You can go look and see the TLT, but the chart still doesn't look that good. On the economic front, there's no major economic news planned for release today, which is good news usually. However, the U.S. consumer inflation report, the CPI, for February will be the main highlight this week. That report will be released on Wednesday and is expected to show that prices increased last month at a pace that suggests slow progress on inflation. And on Thursday, we'll get the PPI. And looking at what I've seen in the manufacturing reports, as far as input costs, it looks like the PPI will probably be up also. So it's going to be an interesting week, especially with inflation, especially with tariffs, especially with everything that's going on. And then we have this downtrending market on top of that. There are some earnings this week. Adobe, I think Oracle's today, Dick's Sporting Goods, Dollar General, Ulta Beauty, DocuSign, they're all scheduled to release quarterly earnings this week. So we're not done with that yet. Yesterday, I put out 10 momentum stocks, 20 stocks trading under the 200-day SMA on the Charts of Interest channel on the Platinum Discord. And of course, these are charts of interest that can be included on your watch list, and they're not a buy list, especially on a Monday when sell orders and other orders are piling up on the market maker's desk for open. And we can already see what looks to be red in pre-market, and it looks to be fairly heavily red. So again, include them on your watch list. It's not a buy list. This is especially true of the current negative market conditions we've been experiencing over the past several weeks. I personally am going to take this week as risk off in market sentiment. I'm not going to really look to try to beat the market. They always say don't fight the Fed. Well, I'm not going to fight the market. In risk off environments, we're cautious, we're risk averse. We preserve our capital. We seek safe haven assets. Okay. Risk off is when we're feeling fearful and are seeking safety, as opposed to risk on when we're feeling confident and willing to take chances. Chances are closely tied to whatever your risk management strategy is. I'm pretty risk averse, so I like keeping my money. I don't like losing my money or risking it on higher risk. But that's just me. Other people can have a higher risk depending on your financial situation. Maybe you have a high risk account, you like to play in it. That's fine. As a swing trader, which is what this channel started as, and moved more into investments and stuff. But today, for me, will be a day of patience. I'm not going to chase the market. I'm going to let the market come to me, which it hasn't. Overall market momentum is definitely not in our favor. When I looked at some of the big movers this morning because of news, Redfin was up 77% in pre-market after Bloomberg reported that that Rocket Costs agreed to buy the company in a deal valued at $1.75 billion. DoorDash climbed more than 4% in pre-market after the S&P Dow Jones Index announced that DoorDash would join the S&P 500 on March 24th. So a lot of the index, everyone's got to buy it. So that's why DoorDash is up. Other than that, let's move on to a little bit of charting, and then we'll move on to other things. Again, I wanted to let's see if I can share this. Thanks, Trent. Every week, Sundays, I put out lists. Again, it's in the charts of interest. Okay, under Discord and the Platinum channel, here's the momentum charts of interest. I had 10 of them. There weren't as many as last time. You can see, be cautious. There's some commentary in there on, why they might be a little more risky. Here's charts of interest for the under the 200-day simple moving average, which we have 20 of them this time because there's a lot of stocks trading other than the 20. But you can see the trends are kind of up on those. But again, let's wait until the market opens before you get too excited about getting into that. Let's go look at where we are. And again, I was talking all last week, and this is the SPY. We have been bouncing off this 200. We went and wicked under it, closed above it. This is really the line in the sand for me. This is why I'm neutral on everything. If this can continue to bounce but come back up, that would be a good sign. And then we're going to see some momentum come back. We're going to see some setups come back. But right now, we're seeing the oscillators are down flat. MACD looks bad today. Looks like it's a bad day. I don't want it to cross under, and stay under sustainably. But look at the lower Bollinger Band. Look at the moving averages. It's got to go all the way down. If it gets past here, we're looking at 557 on the SPY before anyone's really interested in trying to take a bite out of that. You look at the Qs, we're really kind of in trouble on the Qs. Okay, we closed underneath, tried to make it back. We got Bollinger Bands just screaming down. We got moving averages screaming down. Oscillators looking bad. If this can't get past here and continues down following the Bollinger Band, that's going to be more bad news for the technology sector. And then the Dow, which is down over 400 some points today, you can see it's been bouncing off an intermediate support level, coming down. Again, the trend is down to the 200-day moving average. And this would be the last one to fall. It's 30 stocks, usually the bigger, older stocks. But the oscillators don't look very good on that at all either. And then the small caps, again, they've been under the 200 and down. You can see they've come down to intermediate support level, and for like 4 days they've been hitting. We'll see if this flattens out and we have any turning. Doesn't look like it so far this morning. Like we were talking earlier with Paul, I mean, there are some inverse ETFs that are inverse, so they short the market actually. And so this is a short S&P 500, and again, it's been trending up as you saw the other chart of longs going down. Again, it's hitting its 200-day here, and we'll see if it gets past that. These are a lot more risky. They're used for days. You trade for a day at a time usually. You don't hold them overnight. But if we see that go past that 200, it has room to run up, to the top, and that's on the S&P. There's some shorting that you could do on the SQQs. This is SQQQ. This is a Ultra Pro short. Again, we've hit some resistance here. We'll see. This one hasn't quite made it past its 200 yet. Again, these are highly risky, but like Paul said, you can go on the short side if you dabble in it. You make sure you get out of those because they can turn on you really pretty quick. If you look at some of the momentum stocks, there were some in there, and this is a European fund. And if you look, there's been a lot of money moving into European funds, even though the economies over there are kind of bad. But this is an ETF, and this is one of momentum stocks, EUFM. Play them like a momentum stock and watch out for upper level resistance levels are under the 200s. There are some nice looking charts that started out last week. Last week was a bad week. Like here's Evolent's Health. has a nice looking chart, has a nice oscillators, but again, the momentum in the market today is a little off. As we see, CCI is another one we've been following under the 200. It's been a nice runner up. It's got a ways to get up. Let's move this up and see where the stops are. Yeah, they're up a little bit above. So again, there's stuff out there, smaller stuff, riskier now, just because of where we are in the market. When you look over to some stocks above the 200, there's Fastenal, and this is, Bob, you might have some comments on this one. This Fastenal took off the last 2 days, you know, above the 200. I don't see any news or anything. Here's a distribution, here's earnings, but Fastenal is definitely taken off, but it's way outside the upper Bollinger Band, and we're getting close to where sell orders are, especially on a day like today. I expect this to pull back in within the Bollinger Bands. And then same with like income, or reality income REIT has crossed over its 200 and kept it. Again, it's falling right between the Bollinger Band and the 9. Again, this is something that last week, you know, the markets weren't doing so well, but you know, this kind of fits my trading plans. Would I get into this today? Not for me. You know, I want momentum. I want upper momentum in the market. So basically, no for me on this one. And then I want to go to one more. Try to get out of here. Bitcoin's been interesting all weekend. You can see it's still fighting the 200 right now. It's sitting right on the 200. Again, we got Bollingers, but they're starting to curve a little bit. We'll see. The MACD is kind of flat, but again, it's been fighting on this to get past the 200, and it's like the S&P. If it can get past it and stay under, it's going to be trouble for Bitcoin. But if it can move up and maintain the support at the 200, you know, it'll be better than what we are right now. But again, neutral zone right here. I play a little bit. And when it hits down in this area, I pick up a little bit just because I'm going to keep it. But it's very risky, very volatile, depending on where your cost basis is. You know, these are kind of charts you want to wait and see which direction it's going to take off on if you're going to trade them or invest in them usually. So that's what I got right now, guys. And as fast as I can go through it with what I'm seeing, I'm going to turn it over to Trent, and then we'll open it up to what you guys think.
We're gonna hit upon a couple things here that I think are relevant to what's coming ahead. Just as a review, let me know when you guys can see this. You see it?
There's
So this is the 10 or US dollar. We continue to see a decline, a weakening the US dollar, continuing. This is the S&P 500. It's not open yet, but it is projected to open lower. And then the 10-year US Treasury yield is down to 4.24%. This is going back to what I was talking about with Scott Bassett, Treasury Secretary of the United States, basically said on CNBC, thank you, Bob, for the FYI on him talking. I went and watched the whole interview. It's pretty blatant. They're trying to drive yields down. He's pretty stunned about that, which means money's going to flow out of equity markets. The other, so I started looking at the Japanese 40-year bond yield is at an all-time high. The 10-year bond yield is up again. So they're also raising rates, which is unheard of in their, over the last 30 some years. They're raising rates to fight inflation, which is driving their yields higher, and value or money's flowing out of Japanese bonds, as well as we've seen with Europe. Now, it's not as substantial as we're seeing with Japan, but money's flowing out of Europe because of the recession they have been in, probably since 22. And I think what we're going to continue to see is that flow of money out of equities on a global scale, away from countries that are financially and economically weak, like Japan, like Europe, Japan or Germany specifically, and it's going to flow into the United States. And I think that is a telltale sign of one, we're entering an environment of recession. If I can pull up one more chart here, I'll make it quick. Bear with me. Here a second. Thought I had it ready, but I didn't. Is where is it? Yeah, when you guys can see this one.
Okay, yeah, it's a little small, but we can see it. There you go. Perfect.
Okay, so every recession follows a peak in Fed funds rate. So we've had basically a peak in the 90s. Fed fund rate comes down. We enter recession. Fed fund rate comes down. Peak in 2000. In Fed funds rate, we enter recession. Fed fund rate comes down into 04, 05. Peaks again in 06, 07. We go into recession. They lower rates, basically scraping the bottom for a long time. We go into the pandemic. Prior to the pandemic, they've got rates high again. We go into recession. We're right there again. And so chances are we are experiencing and will continue to experience, I think, through the summer, is we're going to start entering a recessionary environment. And even if they don't call it as a recession, it's going to feel like it. And we've all talked about this for a year now, but I think we're now in this is speeding up. This is getting, things are starting to happen. We're starting to see equity markets pull back. And with that, and as yields on the 10-year and US Treasury yields go down, money's going to flow in. So there is opportunity in the bond market, specifically US Treasury market. And you're going to then see a Fed funds rate start to come down. And that's going to create opportunity for another move higher. And I think we're just in this period of 6 months where this is going to transact. And so, as I wrote today in the 12 newsletter I sent out, and I've included Platinum in it today, this is just an environment where everybody globally is moving from risk off, and they're finding risk places where you can hide away. And the U.S. Treasury is still U.S.
You mean for risk? You mean for risk on?
Yeah, they're moving away from risk on to risk off.
Right.
And they're looking for a place to hide. And still to this day, we are the best choice in a bad neighborhood economically. And that's what I think we're seeing. So be patient here. And as Paul has pointed out, he's taking advantage of the sunshine below his feet. He's getting into the shorting. And I'd still be very careful of that if you decide to dabble in it. But I think we're going to continue to see this selling go on. And we're seeing it in the VIX today is just under 27. We start to break and close above 27. These markets are going to get super volatile. So be patient and be safe. But look at what's happening globally in the global bond market. And look at how yields are starting to rise, because that's an indicator money's flowing out of what used to be safe and bullish is going towards us now in our bond market.
See, I don't think that we're going to see the Fed funds rate go down. I think it'd be more likely to go up with these inflation reports. It's really key on Wednesday and Thursday, these inflation reports, because inflation keeps trending up. There's no way they can lower their rates, in my opinion.
Let me be specific. Third, fourth quarter of this year, I think you're going to see. Today, no, their hand isn't forced yet. But if you get 10-year yields down around 3 and below, and people start screaming, and those delinquency rates go up on credit cards, as Bob pointed out to me, foreclosure rates start to escalate, you're going to see the Fed take action. And it may be fourth quarter, first quarter of 27. We're 26 right now, right? Yeah. No, 25. So it'd be first quarter 26. Holy crap. I can't even believe it's March 10th. So
But
anyways,
that wouldn't be the Fed though. The Fed, they only control the short end. They don't control the long end, and
right.
the 10-year.
But
That's controlled by the bond,
well,
vigilantes. They call them.
but what you'll see is that quantitative easing come back into play. And I think that's
That's
what
true.
they're trying to get, because at some point, as we've experienced pandemic, the great financial crisis, .com, go on back, when liquidity just gets sucked out of the system and the consumer doesn't have this money to spend, they've got to loosen up. And if they don't, they just have to do something just to create confidence back into the market. And you've seen it every time that we've seen a recessionary environment, but they always do it at the peak of rates. And that's sort of where we're at right now. So, but we need to see that squeeze on them to make a change. But I don't see it coming until third, fourth quarter, if not first quarter of 26. But I think it's coming. So
You're more of a Karnak than I am.
oh what?
Karnak, the
Karnak.
magnificent Johnny Carson. He was Karnak.
Oh yeah.
Yeah, he's
I
predict
am.
the future. Yeah. So
I
anyway,
am.
okay, guys. Sorry we took up too much time. Go ahead. Open up, Bob.
Are you in New Jersey right now?
Can't hear you,
Can't
Bob.
Can't hear you.
Bob. Something's going on with your sound.
Can you hear me now?
Yep.
Yeah.
Good morning.
Good
Good
morning.
morning.
I'm in New Jersey. I fled Florida on Saturday because the Players Cup. It's like 150,000, 175,000 people come into Ponte Vedra.
Wow.
It becomes insane. And it's a little town, and there's only a handful of restaurants and places to go. You can't even drive. It gets so crazy. It's just bananas. But anyway, yeah, I'm back in New Jersey for 2 weeks, and I'm heading back after the Players Cup for the golfers, if anybody is here. I sent you a bunch of charts on the weekend that
Yeah.
show that we are in my opinion, 2006, 2007 right now. If you look at those charts, the repeat is actually happening. And I don't know, I've been following a trend. I haven't shared this with you, but I've been following the active homes for sale in Jacksonville area, St. John's, Duval County. And the numbers, Flagler County, the numbers are going up every week. Houses sell, for sale. Now, what that number is a whole nother discussion. But the inventory is now, it went from like 7,000 to 10,000, over 10,000 now in the last several months. So my point is that that shows to me in this market, people are under stress. And this goes back to what you were saying about those mortgages have to get refinanced. That they're in, and they probably don't qualify or they can't afford it anymore, specifically because these houses have tripled in price and the taxes and the maintenance of them has skyrocketed. But yeah, I agree. It's risk off. I've been risk off for over a week now. And on the comment about Fastenal, so there haven't been any hurricanes, so they haven't had to supply the government with any barriers or hurricane products per se. Manufacturing is down. They're not manufacturers. They're distributors. So I would sense to believe it's a good spot to short them because I don't see their forecast Because as I told you guys, we are in a big funk. And it's just dead. So I'm gonna short that. Because I feel that they're not gonna, even if they make their numbers, their projections, they're not gonna be able to come out with a good forecast going forward.
Yeah. They got a big headwind.
Not financial advice.
The gospel according to Bob.
That's right. Proceed at your own risk, but
Yeah.
that's something I'm probably gonna do because I know the market. I know what's.
Yeah.
Mark,
What do you think?
what is
What do
your-
you think caused? What do you think caused that 2-day, skyrocketing candles for
I don't know
Fastenal?
what so there's been a lot of talk on CNBC lately about investing in industrials. It's the analysts pumping the stocks, and maybe it's retail thinking, hey, yeah, this is when industrials start. No, it's not. We haven't.
You're right.
We're not there. So I think it's just a pump going on. People are looking for places to invest and not making the money on AI right now. And I think it's moving around. It doesn't make any sense to me unless you can come up with someone that's on the inside knowing something that we all don't know and they're buying.
There's some type of presentation going on Wednesday. They're having something going on. Fastenal. I
Oh,
put
they
a
are?
link.
Okay.
Yeah, I put the link.
I'll
in
take
the
a look
thing.
at it.
Thanks,
But
Paul.
the industry is dead.
Do you think that's all industrials too, Bob?
I do.
I
Do,
would
except
agree.
for if you're involved. Keep in mind, Trump has talked about it. He's going to cut government spending.
Yeah.
And military, he's going to invest in certain things, but he's cutting military. He's going to cut the military budget, and he's going to cut other government spending in our arena. So I think you're going to see a fall because Fastenal switched their model and they're more government, state government, federal government, state government oriented now versus consumer or business direct business to
Commercial.
Yeah, then they cut out contractors altogether. That whole industry, because they got rid of a lot of their stores. So they're
Yeah.
not wasting their money on the stores or the walk-ins anymore. They're more focused on state and federal government.
I went through on the Zoom Platinum call if anyone wasn't on it, and Trent's got it up on Platinum. You can go watch the recording. Just the GDP and the 4 sections of the GDP, which is consumption, which is retail spending, which is 65-70% of the economy. We also talked about government spending. We talked about it.
93%.
And we talked about investment, business investment, and then government spending. Those are the 4 main pillars of GDP, and all of them to me look to be going down, especially government spending, which has been kind of propping up the GDP at its 2% rate. So I'm expecting that, like the Atlanta Fed, why did they cut it down to negative? That's why.
Right. Exactly. And as you listen to that whole conversation, Trent, about Bassett, they're going to press this 10-year yield down.
They have
Can
to.
you-
pressing it.
Can you
Let me
put
show
that
you
on
this
the?
chart real
Can you
quick.
put that on the? Can you put that on the link so everyone gets that interview?
Yeah.
Thanks.
It's
Give
an
me one
amazing
second, I'll
interview.
do
So
that.
much insight in that.
Yeah, he's a smart guy.
Oh yeah, he knows what he's doing.
Yeah.
Hey,
So this is a reason why he's doing this, why he wants to drive it. We have 9.2
Bingo.
billion. Was it billion or trillion? Coming due this year. I mean, look at the difference. That's gigantic. It's got to happen. I think that just right there tells you how you need to start looking at this market.
Is that commercial or is that all?
That's US.
All?
That's US debt.
All US,
Government.
yeah.
Oh, yes.
That's all
Okay.
US
Yeah.
government.
Yeah.
Yeah. Give me a second. I'll find that link to the CNBC
Yeah,
interview.
that'd be awesome.
Uh,
Yeah, there's a lot of stuff happening, and it's gonna be interesting for sure.
yeah. But there's opportunity, and I wanted to ask this question, Mark, and to the group here. IEF, TLT, are these opportunity times to do this, or are we not over a level that we should be considering them?
Well, I mean, you got to be careful. I mean, and I go to the charts to tell me what's going on. Here's
Yeah.
TLT. Okay, yeah, TLT will be up today, but the oscillators aren't looking good, and we're up against some resistance. We're under the 200 still in the TLT. So technically speaking, TLT is still in a bearish market with bearish looking indicators. So, but it'll be up today. I think we're in a neutral zone, but until I see, this 200 has been showing up just about everywhere, and
Yeah.
and I got to just see things move past it. Like here, we saw in the Mag 7s, you're seeing a lot of it just crush through the 200. Here's NVIDIA. Okay, crush through. Meta.
This is the reset. We're in
Yeah.
reset.
Meta's not there, but it's certainly heading that
It's
way.
heading there. It's on
Yeah.
its way. It's got that
Tesla.
angle. It's got that
Yeah.
45-degree, 50-degree angle,
Yeah. Tesla's
It has
4
been
days.
fighting it too.
Tesla's 4 days into it now. Okay. Let me go see where people might
Yeah, so
actually.
it's gonna go to the next level.
Yeah. So we're going. Microsoft is. This is. I consider this as one of the premier companies in the country, but it's gone down, and here's where there was some level of support, and it bounced back up, but it's still, that trend is still down. And again, these were 35% of the S&P, 50% of the Qs, and it's just everything's just kind of resetting, like you guys said, and everything goes to the mean. Recessions are normal for economies. They reset everything to the right price. That's what a recession does. And we've been since the great financial crisis, other than the pandemic, we've been with zero interest rates, holding down that the business cycle, so there are no recessions. People have free money to go out and get, well, people don't, but companies did, venture people did, at zero, and go reinvest or buy their own stock back. And that hasn't been the case, since they started raising rates.
Let me show you something. I don't know if you all follow this. It is the let me know when you see it.
It's there.
This is okay, so this is the MOVE index. That is the volatility index for the US bond market, US Treasury market. As you can see, it's like the VIX, but it measures the volatility of bonds. And
go back?
recently,
Can you go back to 2016 to 19? Just curious.
yeah. Let me just make this my main one. Oh, no, that wasn't what I wanted to do. So if I go back, just look at the. So,
Go down to 5-year chart if you wanted,
thank you.
or all. Yeah, there you go. There's 21. So you move it over just a little more.
Bingo.
15. There's 15, 16.
All right, so when is that? 2020? Really, it took that long for them to move to bonds. Well, they started in 2019. You could see before that the jump up.
Right here, yeah. But he didn't really get volatile until this big gap right here. That was February 18th of 2020. How interesting.
That's
Um,
interesting, right? How long it took. I mean,
Yeah.
that started 2016.
That was right before the pandemic right there. So what did the
Yeah.
bond market know?
Well, I think that's the thing is the bond market is the truth. It's been telling
Yeah.
you for a long time. Now you've got volatility levels back towards where we were during the midst of the pandemic, in the middle of the pandemic of March 9th,
Yeah.
the week of March
So,
9th.
so if you back up, you go back to 2019, you could see the volatility movement into the bonds, but it's not heavy until
Not
you get to
it's normal.
July, until you get to like July, August of
Yeah,
19.
June of them. It peaks out June, the week of June 10th, 2019, drops back, the volatility drops back, and then ramps up again in July of 19. If you remember the whole overnight repo debacle in September
Yeah,
of 19,
Credit
yeah, you had a
swaps.
big, there was no bid. And so like yields went up on overnight money to like in the 10% range. So you're seeing that in August. And then, as we get back into October, then we get to, so October of November of 19, my wife's, one of her old employees came down with a flu-like thing, and the doctors couldn't figure out what it was. And she had it for over a month, and she was the first person we met who had COVID. And that was in November of 2019. And then you saw the bond market heat back up in this period of time here. And then bond yields spiked. Or excuse me, bond yields jumped or went down, bond, everybody flight to safety. And if you sort of look at where we're at again, we're sort of set, we got a
got
baseline.
a heavy amount of money in bonds.
Well, it's the largest market, arguably in the world.
Is
It's
that
six times
Buffett?
big. It's
Is that Buffett?
six
Is
times
that-
bigger than the equities market, bond market.
Is that Berkshire?
Where?
The move up.
Berkshire.
Is that Berkshire from 22, him building in there,
I think it's everybody kind of building, but I do know that China's been selling our bonds along with Japan, and
Yeah, they've been dumping our paper.
yep.
But if you think about that, if they're selling them, yet our yields are going down, somebody is buying them in a very big way. There you go.
Every Tuesday.
Yeah. So when you can look at on Trading Views, you just type in MOVE index, and this will give you some insight to the U.S. bond treasury market.
Did you put up a chart?
Insight.
Did you put up a chart of the VIX yet, just for the equities?
Oh,
Okay. Put that
not
up. Let's
yet.
take a look at that. VIX
Okay.
is a volatility index for equities. You got it, Andy?
Yep.
There we go.
Get this so this is VIX going back to November, October. Today we're at 2643 pre-market. We're right below that 27 mark that I use as the when things get really nasty. If we go back and let's look at
Look at that, 2019. Look at that.
right in here.
2018.
It's
Yeah.
18.
Yeah.
And the
And this,
pandemic.
if you look at this, so that week of February 5th, 2018, this is the volatility of the S&P 500. So when the VIX goes up in value, the S&P goes down.
Yeah.
So where was the buy opportunity? Well, it was the week of February 5th, 2018. And then you had another buy opportunity December 18th or excuse me, the week of December 24th, 2018. Isn't that when the Fed raised rates and then was forced to lower them again?
Yeah, because we were actually, most of
Yeah,
the
and
time
then
I
it really
said it,
took off.
we were technically going into recession in 18 and 19, and then the pandemic hit.
Yeah, and but 18 and 19, they were in 18, yes, he's right. In 18, they were forced to lower interest rates again, and that's what brought us to 2019, that peak again, because inflation spiked at that point.
Yeah.
Yep.
And then you
Yep.
got into the pandemic. So the week of the 18th of February 2020 was sort of the eye of the storm, and then we took off the next week, the 24th, and everything broke loose at that point. But today, okay, go my words there, but we're back right where we were, right
My
here.
question is, where can you take that part where you drop down to the end? Where can you overlay that?
What's that? I'm not
In
following.
other words, the market repeats itself. It's always repeating itself, trying to find where we are in the actual. Some people look at the VIX as volatility, but there's always a pattern to these things, right? And
Right.
what I'm saying is taking from where it dropped at the bottom, going back about 3 inches and taking that part and then pasting it and trying to see where you are approximately in the cycle.
Yeah. Well, I think this is
I look
an
at those
indicator
things.
of liquidity. I mean, and that's the thing is, you can say earnings, you can say all the fundamentals, but markets go in economic cycles. It's no different than the seasons we experience when it comes to weather.
Exactly.
When money is expensive, like we have seen with the raising of Fed funds rates and the rise of US Treasury bonds, money's expensive. People don't borrow. And then you have that cycle where liquidity dries up and markets contract. And I think we're just in that. And what the volatility indexes like the MOVE and the VIX, there's also one for the NASDAQ 100, one for Apple. It just gives you a insight to what the smart money is doing with their money. And when you see these spikes, they can create havoc and they can create opportunity. And I think that's where we're at. If we see the question is, what will cause the VIX to spike over into the F bucket, and what event will happen? Now, I've talked about it a little bit, but this quarter is one of the largest quarterly option expirations, and we're coming into that on March 21st is where it's called triple witching, but it's one of the largest in history. So is that it? Is that what causes a big spike, or is it some geopolitical event? I mean, Xi Jinping was talking over the weekend about, don't get, we've got a noose over around your neck, Taiwan. So be careful. I mean, there's a lot of geopolitical stuff that could break loose. So I think that's when I look at the chart like this, or I look at the move index, which is volatility index for treasuries, what it tells me is we're just in a really we're basically walking across the Grand Canyon on a balsa wood bridge, and any more weight, the bridge is going to give.
So
And
when you talk about
you got to be careful.
So when you talk about triple witching, are you talking about this is when they start readjusting their portfolios also?
No, this is when equity options, index options, and quarterly future options expire. So
They
it's
will,
all
though,
in
Bob.
one day.
They will at the end of March. They'll do some window dressing for quarterly reports, at the end of March. So that'll be first quarter. So you'll see some of that. managers of funds try to move over into, out of bad stocks and into good sectors, to make they
Oh,
call it window dressing, to make their portfolio look better.
I think that's sort of a separate thing though from,
No, it is separate. Yeah.
yeah. But you're absolutely
They have
right.
to
I mean,
balance,
you can,
they have to balance their portfolios, rebalance them.
Right,
Oh.
window dressing, they got to make it look better than it was because they missed it during the quarter, basically.
Okay,
yeah. Yeah. But this is one of the largest option expiration quarters of the year, or actually not of the year, of history. So that's where we saw a couple Fridays ago, what, 2.7 trillion in options that represent 2.7 trillion. The other side of it is I was reading something yesterday about how 0 days to expiration options on the S&P 500 are represent about, what was it, 300 some odd $billion on daily trades. And if you look at a equity market, 0 day expirations on equities and derivatives or future contracts on a daily basis, we're well over $1 trillion a day that is being transacted. So these markets can get real volatile real quick. So with
Yeah,
all that said,
they already are. So we'll see.
yeah,
Anyway,
all right,
it's about time to open in about 12 minutes, market open. So
yeah,
we should probably get off, let people see what they're going to do for today. Be careful.
yeah.
Don't let the market come to you. And right now it's not coming very well. It's, there'll be little pockets, but a majority of my screen is red right at this moment.
Yeah.
So
I would be curious to hear what other folks have to say regarding their plans today. I know I do, and I know we got to close it up right now, but regardless. And the other thing, this is like a continuation of what we were talking about on Friday. Perhaps we should have a recessions diagram channel. Pretty cool charts that we put up that are indicators that we're heading for, maybe, where we are, like that St. Louis one and the diagram of interest and debt and so forth, because we're chatting about it so much and we're referring to diagrams that perhaps there should be a little place for it, or a place for it.
Okay.
You know what I mean?
That would be hard. Yeah,
Yeah.
just everybody can contribute something to that subject matter.
Yeah, and I think
Is
we
what
should
you're
spend
saying?
some time for also during this morning meeting. We should give an opportunity to learn what's in everybody's mind, not just, you get carried away here. It's like a
No,
continuation of,
well, we have an open discussion. Anyone can jump in at any time. So
yeah, I know, but you want to be rude and cut in front of people. That's my point. That's
No, I feel free.
no, you guys feel free to be rude. We're good with that.
Yeah. All right. So we'll be back here tomorrow at 7:30. Just so everybody knows, the link that you see that you came here today with will be the same link for the next basically 20 weeks. So if for some reason you're having a hard time figuring out where the link is, just go back to this one, click it, you'll be able to join. So it's the same week for a while now. And when I do make a change on it, I'll let you know. So because I think somebody had some trouble getting in, and I apologize, but it is the same link for the next probably 20 weeks or so. So
the links in the
all right,
Discord.
it is in the Discord, and I'll highlight it again today. But thank you all for coming. I really appreciate this. Mark and I said last week, this has been fantastic. We've had some great constructive not constructive criticism, but some good, positive feedback. So anyhow, all right, let's get going. Have a great week. Have a wonderful time today, and always live loud. See ya.
Thank you.